Welcome back to Give Me Some Truth. Alicia and I are here to talk today a little bit about RMDs, which, we talk a lot of vernacular in this industry. And so I think we should first define what an RMD is so that, like you said before we sat down here, that sometimes you're like, yes, you got to take your RMD this year. And then the client kind of looks at us like, what's an RMD? And then you explain what it is and they're still like, okay. So we're going to dig in a little bit more about what they are and why you have to take them.
Yeah, so RMD stands for Required Minimum Distribution, and that is often not enough to actually tell people what that means. But basically, once you turn a certain age, you're required to take money out of your retirement account, and that's a 401k or a traditional IRA. It is not a Roth IRA, which is an important distinction. But once you reach a certain age, and that age has changed, so currently it is age 73, and then eventually it's actually going to rise to age 75. But you're basically required to take a certain amount of money out of your retirement account every year. And there's rules around how much you have to take, that's a specific amount. And there's also things that you can do to sort of change that or lower that. But those are things you have to plan for ahead of time.
Yeah, and, let's go to the why. What's the reason? Why does the government require us to take money out? And that's simply because they want your tax money at some point. You've decided and been allowed to defer all of this income. And eventually they're like, hey, sometimes we want to get our taxes. And so they're going to make you take money out of IRAs or 401ks. Or, if you inherit money, also there's required minimum distributions off of those many times as well. So that's kind of a 301 sort of series, but for today's purposes, we're going to focus mostly on just RMDs and how to take them out of retirement accounts. So as you alluded to, age 73 currently, and that was done in some recent legislation as well.
Secure Act 2.0 changed the age to 73 because it was 70 and a half. And then it went up to 72, then it went up to 73. And the interesting thing about that, though, is back when it was age 70 and a half, you could do something called a QCD, which is a qualified charitable distribution. So instead of being taxed on your RMD, you're now donating money to charity, and now you're not paying tax on that RMD anymore. And the interesting thing is you can still do QCDs at age 70 and a half. So before you're required to take money out, you can start doing those charitable donations, and then that'll reduce the balance of that IRA. So then in future years, your balance is lower and thus your RMDs are lower. Yeah,
it's a great way to keep money off of your tax year by year, but also to be charitably inclined. And what a great, powerful tool it has. And we have to do the calculus when we do that, because some people do a donor advised fund, some people donate highly appreciated stock. Some people just write checks for regular donations, and some people take this QCD. And so really getting together with your advisor and saying, okay, what path for me is the best? And oftentimes that comes down to actually looking at their tax return and modeling out some numbers for them.
Yeah, and we have the ability to kind of run a bunch of different scenarios and say which is better for you from a tax perspective. And not only that, RMDs, they're not required till you're 73, but it's really something you want to be thinking about even before you retire, but especially once you retire. You don't want to wait until your RMD age to start thinking about taking money out of your IRA. You might have income, you might have other accounts that you're taking money from, but if you wait and just let that account grow and grow and grow, you might actually end up in a higher tax bracket once you hit RMD age than you were in while you're working. And there's a lot of things that can be done to avoid that if you plan far enough ahead. And it's one of the things that I love to do is show clients what that can look like, and whether that's doing Roth conversions, whether that's starting QCDs early, or whether that's just maybe that's where you take some of your income from and people maybe don't want to touch it. But if you start pulling a little bit of income from that before you're required to, then those RMDs aren't going to be so large.
Yeah, that's a great point. If you end up with a 7-figure IRA, which many people do, your tax situation is somewhat limited once you hit that RMD age. So you really do have to start planning before now age 73, because, you may have higher income, you may have higher Social Security taxes, you may have a situation where, you end up with the extra Medicare premium. All of that could occur if we don't do planning ahead of time. And so really where it comes down to is when you hit age 55, if you're in a 401k plan, or 59 and a half when you're in an IRA, those are the times where you need to consider, where are you at in your working career? Are you stepping down? Is your income going down then? Are those good opportunities to take some of that income, pay it at a semi-lower tax bracket? There's great planning opportunities, but you really got to get to somebody before then and plan that all out. Make sure that you're working with a financial advisor and a tax professional at the same time, I would say, because a tax preparer in many cases is set to minimize your taxes each year, where our goal is to maximize your after-tax wealth long term, right?
Yep. Yeah, so, we're not just looking at last year's taxes or next year's taxes. We're looking at what are your taxes going to be in 20 years, and trying to sort of minimize that over your whole life. And I think another really important thing is, especially in Madison, we have people who've worked at UW, and there's a great state pension. So we have clients who, between Social Security and the state pension, that's all the income that they need in retirement. So sometimes those IRA accounts just sit there until their RMD age because they're fortunate they have this great income stream. And so what are the things that they can do, to not then suddenly be like, well, now I have pension, Social Security, and now these RMDs. And, they're not really sure how to navigate that.
Yeah, and there's extra nuance on top of all that too. What are you taking for capital gains each year? What do you have for dividend income? What do you have for interest income from savings accounts that we're paying nothing and now are paying something? So we've got a lot of different income sources that you have to account for. So it's kind of a complex transaction and a complex view at everything. So you got to dig into there really well.
Yeah, and what people don't realize too is like interest is taxed at ordinary income, and this is a little bit of a tangent, but now that you can get interest again in savings accounts, people will have pretty large savings accounts balances. So now we're looking at thousands of dollars in interest every year. And so that's not always accounted for when people are thinking about where their income is coming from or what their tax situation is going to be. And that can really make a difference, especially if we're looking at something to how to minimize their taxes, because we're looking at, hey, what's all your income? What is that going to add up to be? And if we're not kind of accounting for something that used to be really small and now is a meaningful amount, that's just an important thing to consider too.
Exactly. And, when we have a situation where you also, prior to, hitting some of those ages, you can, look at like a Roth 401k. You might want to split those contributions a little more. You might want to fill up some of those other buckets, pay your taxes at today's tax rates that are a little bit lower historically. I do believe that we're going to see higher taxation over a long period of time. So if that happens, then we got to account for that.
Yeah, that's another thing too with the expiration of the Tax Cut and Jobs Act coming up in 2026. It's likely that, depending on what Congress does, for a lot of people, the tax rates are going to go up. And paying taxes now, depending on which tax bracket you're in, might actually be a good thing. So that sort of mix of if you have the option to contribute some to tax deferred and some to Roth through your employer, a lot of clients will do a little bit of both because at the end of the day, we don't know what Congress is going to do. So if you're kind of contributing to both buckets, that gives you options in retirement. And sometimes just having multiple buckets in retirement to pull from can be really beneficial as opposed to the person who's all Roth or all tax deferred. Mm-hmm. Because if you're all Roth, then where's your taxable income coming from? You won't have any besides maybe Social Security. And now that's a missed opportunity because you're in the 10 to 12% bracket. So you also don't want to end up in the position where all of your money is in Roth in retirement because you're going to be in a much lower tax bracket then, and you should be able to take advantage of that.
That's exactly right. There's a lot of advanced planning concepts where if you're kind of in that not too hot, not too cold area, like that's exactly where you want to be. And you have to start planning for that when you're in your 30s and 40s. Even though you might not know what the future brings, we can, tax diversify you and make sure that you're in a good spot there. Also, I think that's where the concept of, direct indexing comes in too, being able to manage capital gains and capital losses in a taxable account. And that has, an impact on your retirement accounts as well. So there's a lot of different things about asset location, where it can be really important for your long-term financial goals. And I love having flexibility. Like with our clients, when I get to look at it and we see taxable accounts and tax deferred and tax free, and they're kind of equal buckets, that's like perfect, and we know that we can go any direction that we want to do. Because say, for example, you want to buy, what was your favorite car that you said that like, you had a dream car? What
Porsche Cayenne.
So if you bought a Porsche Cayenne, and you only had IRA assets, you think about that. Your Porsche Cayenne, well, I don't even know what a Porsche Cayenne costs, but let's say it's $100,000 now.
Yeah, it's about $100,000.
Yeah, so you're going to go out and treat yourself for your retirement gift, and you only have money in IRAs, and you're age 60, and you want to buy that purple Porsche Cayenne. Well, then you might have to take out $145,000 to get down to that $100,000, depending on when your tax bracket is. If you had it in a Roth and you said, I'm treating myself and I'm taking that Roth asset or that taxable asset that I got to manage gains and losses together, well, then you might only have to take out the $100,000. So it does have an impact. There is a tax on your distribution, in your net worth. So you got to be careful about where you take it.
Yeah. No, that's really hard, I think, when people just have tax deferred assets and then they have a big expense, whether it's a medical bill or they want to take a big family vacation and now they want to pull out extra money from their retirement account, but that's all tax at ordinary income and then they're trying to manage that. But if they don't have money in a taxable account or in a Roth account, they don't have any flexibility. And so they're kind of forced that if they want money, that's where they have to take it from.
Exactly. Yeah, I think that those are great places to manage and opportunistic places where we can look at that and say, when working with a financial advisor, there's a cost and a benefit to everything that we do, every bucket we put it in. And what we're trying to do is make the right decision for people and say, well, this is better. And I would edge towards, in this situation, Roth and taxable accounts over tax deferred, because the tax deferred bucket's really a big time bomb in the end. And then all of our matches end up in that tax deferred bucket. So that's why it oftentimes is tilted the other way. And so we have to manage for that going forward and making sure that we're putting it in the right after tax spots. Yeah. Any other nuances or items that you think people you want to highlight about RMDs and how people are taking them, or how to plan for distributions?
Well, I think you can check out the blog post that kind of gets into some of the timing, like there's different rules around the first year you take RMDs versus when you take them in subsequent years. Like I mentioned earlier, the age is going to change eventually. It's 73 now, but it will be 75. So there are some kind of more nitty-gritty logistical things in the blog post. So check that out. It kind of goes through a lot of the basics. And then the really advanced course at the bottom, I start to talk about inherited IRA RMDs. And that is complicated even for advisors. It actually took several years for them to come out with clarification on rules surrounding RMDs for inherited IRA accounts. So even advisors were confused. They had to come back and say, you know what, you guys aren't required to take RMDs because these rules are not clear. And now they've come out with additional clarification on that. So we know what to tell clients to do there. But for years, RMDs weren't required because we didn't really understand what that looked like. Now we do. But based on when the person passed away, based on your relationship to the person, there's a lot of factors that determine how long you have to actually drain that account, whether it's 5 years, 10 years, stretching it over your life, and then if you're required to take required minimum distributions from those accounts. So definitely check out the blog post. I link to some other resources in there, but that's one way that we really help our clients too, is by navigating that for them.
Great. Well, so a little bit more on RMDs there. Check out the blog post when you get a chance. Thank you for joining us for this episode, and we'll have more on RMDs and probably beneficiary IRAs at some point on another episode of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.